warm welcome to everyone and thank you for joining this Hardman & Co Investor Forum. My name is Keith Hiscock and I'm the Chief Executive of Hardman & Co. These forums give investors the chance to hear a company's investment case and question the management. The fund presenting today is Tritax EuroBox. This is an investment company quoted in London that gives investors exposure to continental European logistics real estate assets, i.e. warehouses. It's got a market cap of £440 million, a very popular sector at the moment, and we're very lucky to be joined by the fund manager, Nick Preston. Nick, over to you.
Right, thank you very much, Keith. Yes, thank you for that introduction. And let me just start off my brief presentation to you by just providing a very brief snapshot and building on those few words you've just said, Keith. As you say, Tritax EuroBox is a premium listing on London Stock Exchange. We are an investment trust structured to invest in real estate assets across continental Europe. And by that, we really focus on Western continental Europe, the developed markets and big population centres. I'll come along in a minute about a little bit more about our investment approach and how and the type of assets we actually buy. Now, we IPO'd 2.5 years ago in July 2018. And while we do have a strong focus on income, the market in which we are operating at the moment, as you said, Keith, it's a very exciting, fast-moving and growing dynamic market at the moment. We are adjusting focus slightly to more of a value-add approach through asset management initiatives, innovative acquisitions to be able to take advantage of this dynamic market and delivering returns to our shareholders. Over the last 2.5 years, we built up a stable performing portfolio of prime logistics assets, as I said, across Western continental Europe. Key attributes, and I'll come on to a little bit more detail about this later on, is that these properties that we buy are let on generally long leases to high quality tenants in very strong locations. And we, as ever with any real estate investment, are looking at the income generating capabilities of these properties to be able to pass on to our investors a high progressive dividend. You have to bear in mind that across continental European investments, you always get indexation. And so our rent is indexed to local CPI drivers across all markets. We invest in prime locations, always close to populations where customers are located for the occupiers and also workforce, but also infrastructure to allow access for goods in and out of the properties. We're always keen to buy modern, flexible and sustainable assets. I will come on later to talk about ESG and sustainability, but it is a critical part of future-proofing our portfolio to make sure that the assets that we invest in are fit for purpose for the long term, and that means having very strong ESG credentials. The market conditions, and Keith, you touched on this at the beginning, are highly supportive at the moment. You will have all read in the newspapers, I'm sure, and seen in the media generally, that the logistics market is something that has been changing very rapidly. Now, a lot of this impact and these changes have been in place and happening for quite a long time. There was growth of this through digitalisation, automation, that allows supply chains to become more efficient and simple. And then that couples in with the growth of online retailing, which needs that technology to be able to operate. And so online retailing is a real driver and one of the most important facets of the logistics market across Europe. And it's worth saying that in the UK, the online retail penetration is around about 20% of all the retail spend. And this is pre-COVID. And in Europe, it was around half that. And so we see that there are real opportunities. There always have been real opportunities in Europe for that to catch up as the European online retailing market really continues to grow. And that is one of the key characteristics which we see across our market. There are other impacts which have also been around for a while, but have also all been accelerated also by the COVID pandemic. And this is more onshoring, more stockpiling, holding inventory closer to users, and a movement from, you will have heard the jargon used in the logistics industry from just in time, which was all these very long, thin supply chains with manufacturers in the Far East and delivering just in time to facilities in Western Europe. That is now changing, and we're now seeing a change to a just in case supply strategy, whereby there's holding more inventory closer to either the end users, or whether those be manufacturers or customers. And so that is all of this leads to increased demand for an ever scarcer asset. And the occupiers are looking to lease these properties. And I'll come on to talk about supply and demand in a moment. All of this basically puts the fundamentals of the European logistics market in a very, very good place for us as long-term investors, and allows us to be very confident about long-term sustainable returns to our shareholders, delivering long-term sustainable returns to our shareholders into the future. Just a very quick snapshot. I won't go into too much detail here in terms of the operational highlights, and I've got a map later of where our assets are actually located. But we have a portfolio valuation of just under 900 million euros. We hold 13 assets in 6 countries, 22 tenants, and that comprises just under 1 million square meters of logistics space. We tend to have quite long leases, just under 9 years. I've mentioned the indexation before, and all of these assets are income producing, which enable us to pay a dividend. Now, the market in which we're operating, and as this I touched on a moment ago, in terms of the supply-demand dynamics, which are some of the fundamentals for performance in real estate markets, and we're looking at where the tenant demand is coming from in terms of who is going to lease these properties, and then we also look at the supply side of things and say, are new buildings being built, are buildings available, what are the vacancy levels like? Now, from a demand side, leasing in these markets remains very strong, and the absorptions, the take up of space by tenants, and that has been continuing to grow. And you can see that the graph here on page 5 on the left hand side, that the first half of 2020 saw strong growth, and that has continued, and we're just getting figures through in the last few days demonstrating that 2020, despite the COVID pandemic, was a very similar levels to 2019. And as I said before, a lot of this, the drivers of this, is coming from e-commerce, and these are the European growth you can see here in online spending, and we expect this growth to really continue to rise. We understand that during the COVID pandemic, we saw across Europe the online retail spending increase by around 50%. And while all that won't stick, because people will return to shops, it will have given a lot of people who were not familiar with online retailing a taste for it, and so a lot of that will retain. And all of this leading to further demand for these well-located properties that have to fulfill these online shopping orders to do what the online retailers need, which is to have a huge stock of products, be able to be delivered quickly and cheaply to customers. And looking now at supply side of things, the vacancy levels in the key markets are very low. And I would just take a step back and go, everybody says to me, oh, well, across Europe, there's so much land. I drive around Europe and there's just loads of land. You can build these properties anywhere. And I go, yes, there is an abundant supply of development land in Europe, but it is not in the locations where the occupiers want to be. In those locations where occupiers want to be, there is a real scarcity of land. There's continuing pressure from both the green lobby and planning restrictions against new development, and in particular, development of very large buildings. And we're talking here, the buildings that we buy are up to 1 million, if not more than 1 million square feet, 100,000 square meters, 1 million square feet. These are huge buildings, and therefore there's a natural resistance from communities and local authorities to zone and let these things be built. That scarcity is value to us because we own these, we selectively acquire these, and we see the values go up. And it's worth saying that the combined effect, and this is this chart here on the bottom left hand side, the combined effect of the strong demand and the limited supply means vacancy levels go down, and the immediate effect of that, as vacancy levels go down, then rents go up, and that is illustrated here. Let me move on to talk in a little bit more detail about some of the specifics of our portfolio rather than the wider market. I apologise for this chart, it's a little bit dense, but I like to use it because I think it's a very strong message. This is a population density map on which the black spots have been put, which are our properties. And you can see that, as I said earlier, that what we're doing when we select investments is to invest in locations where there is high population density. That means land is scarce, and it also means there's a lot of customers nearby, which is in particular for the online retailing industry what they need. So we're buying close to these major conurbations, densely populated areas. The infrastructure has to be strong. That's one reason why we like Benelux and the western part of Germany. It is near the major European ports of Hamburg, Bremerhaven, Rotterdam, Antwerp, etc. But also it's where the population density is in Europe, and you can see that area. There are an awful lot of people live around there. A final, more technical point is about power and data. These buildings are generally large, new, and able to accommodate automation. That automation, the machinery, requires enormous amounts of electricity, and it also has to have a very robust data connection onto the broadband, onto the internet, to be able to manage these systems. And so those are other restrictions that we need to be careful about in terms of selecting these properties. So it's all about simplicity, because we buy a building not just for its lettability during the lease that we buy when we invest, but also beyond that. It's over the life of the building. These buildings, because they are simple, they have very low obsolescence, and therefore their lifespan is very, very long, much longer than the immediate lease. Hence, we need to buy assets that are ubiquitous, simple, and able to be let to a wide range of tenants. That's why we go for the good locations with good road connections, good port connections, etc., etc. Some characteristics, and I won't dwell on these for too long. We're well spread across Europe. Our buildings are modern. It comes to the sustainability point. Most of them have been built in the last few years. They're large. Nearly half our assets are over 100,000 square meters in total. Our income is very well diversified. We have a wide range of different occupiers, and we have a spread of lease expiries in terms of when those leases fall in. And we have most of our income is, as I said, is over 5 years of unexpired term. But we do also have some shorter leases which enable us to capture the growing rents we're seeing in our market. And then on top of that, and the point that I made earlier, is that virtually all of our leases are subject to indexation to local CPIs, which is on an annual basis, which just gently grows our income stream going forward. ESG, that, as I said at the beginning, is a critical part of our DNA, really, and we have set some targets for the short to medium term, but also longer term targets. They're all around 4 key areas of owning healthy and sustainable buildings, reducing emissions, so that's less reliance on fossil fuels for carbon emissions, lower energy usage, and reducing costs for our occupiers in these buildings, but also nature and well-being. This is something that's come out of COVID. It's all about quality workspaces and looking after employees, and biodiversity helps in there as well. But then linked in with that is also the socio-economic impact and how these buildings interact with local communities. Strategy and strategic issues. We have very successfully executed our strategy to date, built up a very high quality portfolio which was doing exactly what we wanted it to do. As the market has become more dynamic and faster moving and more expensive because of increased interest and money being allocated to the logistics sector, we've had to be more creative and innovative in accessing accessing new opportunities in order to be able to continue to produce the returns to our investors. So we have refined our investment focus based on the stability of our existing portfolio to be able to capture value, and this is through entering into investments slightly earlier in the development cycle to be able to capture rising rents and more effectively buying cheaper yields than in the past. We're also adopting a more active capital allocation policy of recycling assets where we believe that there are better opportunities elsewhere, and so that is crystallizing profits and delivering returns to our investors that way. I talk about value creation in terms of, and I've put a few photos up here, apologies they're a little bit small, but I think just give you a couple of examples of what we actually do. We're not just buying very dry properties and assets where there's little activity. We can use our management expertise to add further value. We have a property in Barcelona where we're in the process of building a large 88,000 square metre extension. That provides a yield on cost of around 7.1%, which compares very favourably to market yields of around 4.5%. We're also building in Belgium on a plot of land, and this is another 15,000 square metre new building there. You can see that picture of the second one down on the left, some diggers on site, and that was taken just before Christmas, and that's moving ahead now. Also, another example of how we add value, we buy in a more innovative way, and this is what I talked about a moment ago, through buying the land in advance, but all pre-let and with a construction contract in place. We're able to get much more advantageous pricing through those type of acquisition structures. And that property in Wunstorf, which is near Hanover in Germany, has also got a 10,000 square metre extension plot immediately next to it, pre-planned, which will allow us to further drive value in the future. We also buy, and the final one here is in Breda in the southern Netherlands, and this was an asset we bought 50% let to Abbott Pharmaceutical Group, 50% with a rent guarantee from the developer we bought from. We controlled the leasing of that, and just demonstrating the point I was making earlier about rents are actually growing in these markets. We were able to lease the second half of this building to Samsung at a level 6% above the Abbott lease. And so that gives you an idea of some of the initiatives that we are carrying out across the portfolio to drive the value for our shareholders. Just to wrap up now, and you know, we've been delivering robust, strong returns for our investors and fully expect this to continue for a long time to come. The European logistics sector is set very well. There are a lot of significant structural changes, as I've mentioned before, in terms of online retailing and how that is changing the way that retail is being fulfilled. And that is going to provide a fundamental underpinning of demand for a long time to come, which when coupled with restrained supply, we believe will points to very strong performance for a long time to come. Today, we have a very strong balance sheet. You know, we are as a company fully deployed. Our strategy, I think, has proved to be very relevant and able to adapt and grow as the market does. All of this is underpinned. This is not some kind of risky strategy. You know, we have a resilience here through not only our balance sheet, but the income generated from these assets. And that is what underpins the returns. And what we can do is, for having bought the right properties in the right locations, continue to add value and drive returns for our investors. A lot of that comes from our experience, but and our partners across Europe who are working with us on these. And all of this with the tailwinds, as I've said, of the logistics sector generally. So I think that really looking forward, that all COVID has really done is accelerated these effects that were in place already, and we're just seeing a compression of timing on this. And so we're fully expecting these impacts to happen. They've just now been brought forward much sooner. This has been fully recognised in the investment market. We are seeing ever increasing demand from all types of investors to get into the logistics investment market, which we believe will further compress yields in the future, as people acknowledge the potential that this sector has. And so, we're able to capture this through our existing portfolio, but also new opportunities through asset management development partners that we have embedded in Europe, which gives us exclusive access to very high quality assets for the future, enabling us to continue to deliver the sustainable returns that we have done to date. Keith, that wraps my presentation up. Thank you very much, and perhaps hand over. Actually, Richard, you're dealing with the Q&A, I believe.
Yes, I am. So let's just give me a second, and let's start with a fundamental question. So I think we're going to be talking about your company. I think you ought to put Big Box into context because of your relationship, and we're also going to be talking a little bit about Aberdeen Standard and the Aberdeen Standard European Logistics Fund as well. But let's start off with a basic question. Has your experience in the UK with Big Box helped in continental Europe, or is the market very different?
It has helped a lot, and let's just be clear to those who aren't 100% clear. These are two totally separate companies, but run by the same manager. It's Tritax Management. And so I run Tritax EuroBox, which is completely separate to Tritax Big Box REIT. Yes, you're right, Richard, there are similarities. Occupiers in these properties tends to be large multinational companies, and therefore we have overlap of occupier, obviously in different jurisdictions. However, I would also say that there are lots and lots of differences between Europe and UK. I would say the UK market is a very transparent market, very heavily researched, and there's a lot more less fragmented. The European market is much bigger, obviously. It's more fragmented. Every country is different, despite the EU being the EU. They have separate tax and legal systems. That adds a degree of complexity to that. But also there are a lot more micro markets to access. There's also all sorts of technical things about the lease structures are all different, and planning and zoning and all of that type of thing. But fundamentally, the supply and demand is the same. As I mentioned before, there is a lag in Europe on the online retail penetration, which is much more advanced in the UK, which we see will grow across Europe. And Amazon, as we all know, you may not know, but across Europe they are growing very rapidly from a really quite a low base, unlike in UK where they've been operating for really quite a long time. We see that as they expand, the online retailing expands, and that is going to further push our market, which is lagging the UK, the European market, lagging the UK quite considerably.
Okay, thank you for that. So the next question comes from Phil. It's about your tenant concentration. So your top 3 tenants are 44% of the business at the moment. The largest of which is Mango, which is 19%, which is a fashion retailer.
Yep.
Whereas Amazon is your second biggest client, and that's obviously a much more diversified business. Does it worry you that your largest tenant is a fashion retailer or not?
It is something we keep a very close eye on, but knowing Mango as well as we do, and we know them extremely well and have access to, they are a private company, and therefore there's very little publicly released information about them, but we do get exclusive access to their financials. They are trading extremely well. They have really, I think, been a brilliant example of how retailers should and could and move to the omni-channel world in terms of this shift from just physical stores to a combination of physical stores and a very sophisticated social media and online presence, coupled with a market-leading, highly automated distribution channel, which actually is located within our property in Barcelona. And they told us that they're expecting their EBITDA in 2020 to be, broadly speaking, the same as it was in 2019, entirely pre-COVID, which I think illustrates the point that if a company like that, where it's had a huge number of its shops globally closed during the year, what they've done is they've caught up by the online sales. That is what has balanced out the fall in the in-store sales. But I think the other point in terms of giving us reassurance from an investment perspective, the Barcelona market is one of the most undersupplied in Europe. There's virtually no supply of large logistics space in that market. And also we have benefit of up to a 3-year bank and rental guarantee on the property. Should the worst happen and Mango fail, which I fundamentally do not believe will happen, we will then have a 3-year period which is covered by guarantees to release this property in, as I've just said, a very, very strong logistics market in Barcelona. So yes, it is something we can pay a lot of attention to, but actually I personally am very reassured by everything about it.
Okay, thank you for that. So we've got a question from Max that sort of leads on to big box versus your business and EuroBox. And the question is this: big box's share price is at a small premium to NAV, but EuroBox is at a discount, a substantial discount. But both companies collect 100% of their rent, both have largely inflation-proof contracts, they have similar gearing, length of leases. It's not logical why there is this difference. So is Tritax EuroBox too expensive? Sorry, is Big Box too expensive or EuroBox too cheap? Have you any comments?
Yeah, my first comment is that we're actually trading about NAV at the moment. So
right.
I think that
number is wrong. Yes. Okay.
Yeah, that's the context of the question slightly out of kilter. But I think that there's a more general point here that we are trading, let's say, around the IFRS NAV. There are an awful lot of our peer group who are trading at significant premiums to NAV, and that does ask a question. I think that we as a company, I'll be honest here, have suffered a number of large institutional investors having to sell out for liquidity reasons, becoming more risk averse over the last 12 months. That has caused a number, a suppression in the share price. But I think what this does is really, I think that it can, as a selling point to investors, will say, well, the fundamentals of our portfolio, the markets we're in, the quality of our assets is such that, as you just said, with 100% rent collection, very strong, financially strong tenants, that there's no reason for that, and that at some point that the market will acknowledge that, and that we should be trading at a premium, which is really what the market understands. I think what even the direct real estate market understands in terms of some of the pricing that we've seen in the yields being paid for direct assets, about the growth potential within our market. So there's a sort of wider fundamental point there.
Okay, so very quick question: what percentage of rents are currently overdue?
0.
Okay, next question then. Tritax is just over 40% geared. How will further expansion be funded? And that comes from Alan.
A number of sources. As I said in the presentation, we are looking at capital recycling, which is a euphemism for selling some of our assets which have delivered returns already, and reinvesting at some point in the future when the board feels it's right. For investors, we will look to expand the company. We can't say any more on that at the moment, but when the time is right, an equity raise would be appropriate to capture the opportunities we have out there.
Okay, a very quick question, which is probably quite difficult to answer, but there's a lot of commentary on tax leakage and legislative changes for online retailers.
Yep.
Do you have any comments on that front?
In a brief way, yes. I think ultimately those will get passed on to the customers of the retailers. I think a key point is that the rent on these properties, in terms of the rent, the overall rent on these logistics assets as a percentage of the total logistics cost for these operators, is somewhere below 1%. It is a tiny fraction of their cost base. Okay, so I think that any increase in tax, online retail tax, is very unlikely to impact on the rent that these occupiers are able to pay us, and the supply demand dynamics in the in the property market, in the real estate markets that we invest in, are likely to lead to strong rental growth, which won't be impacted by any tax issues at a higher level.
Okay, so just we're moving towards the end here. We've had a number of questions about Aberdeen Standard and its investment in the parent Tritax.
Yep.
And we've had a number of questions about the ASL funds,
yep,
as well. I'm sure you can't answer this question, but from a strategic point of view, are you able to make any comment about the relationship that you have as a business at a parent level with Aberdeen Standard or not?
The deal hasn't finally closed yet. We're still awaiting regulatory approval. However, the plan is, once it does, that Tritax as a business will be autonomous from the main Aberdeen entity. However, I would say, and I suspect this is where these questions are coming from, as to what are the future prospects for both Tritax EuroBox and Aselli, which are operating in broadly the same space with similar strategies. My answer to that is it's still too early to say, other than it is a very obvious question to ask. And I know that both boards are considering this, and ultimately, we are the manager. The boards are the ones who will make decisions on anything here, and they are considering this and will be considering it in due course. I strongly suspect that this will take some time. That the acquisition of Tritax just needs to bed down, and the boards will sound out what investors' views are. And be analysing the pros and cons and there's an awful lot of complexity around this, as you can imagine. But it's too early to say yet, is the first answer. However, it is an obvious question to answer. Therefore, I can't really say any more than that at the moment.
Okay, so we've got a number of questions about, obviously, the leases are linked to CPI.
Yep.
But you are able, or some companies are able, to put in additional services to increase their value. So, for example, what about solar installations on roof and other sort of green initiatives you can undertake that are beneficial not only to the society and the economy, but also to the company, to get your rate of return exactly higher than the CPI?
Yeah, well, that's less a CPI point. It's more of just a total return driver in terms of providing us with future income. We have a program in place at the moment that our head of sustainability is going around every single one of our assets that does not have, or is at least not, who is not 100% covered by solar panels, and looking to expand and grow into that, because it's a very obvious thing to do. Different countries have different rules in terms of tariffs and goodness knows what. It's all very complicated, but we are looking, and our property in Pina near Hanover, we are just embarking on that at the moment. The Barcelona extension that I mentioned, we'll be putting solar panels on the roof there. It's something that we are doing. We're rolling out not only from an ESG perspective, but also from a plain commercial perspective. It does make money for us and for our investors, and so it's a good thing to do on lots of different fronts.
Okay, so we now have a question about funding the growth of the business and the involvement of private shareholders as opposed to institutional placings. So do you have a comment on how you're going to involve private investors with expanding your shareholder register in future, or are you going to be largely dominated by core institutional shareholders?
We like both. We like institutional shareholders. We like the retail shareholders. It's a hypothetical question at the moment because we've got no plans and nothing to say on that at the moment. However, as I said, we fully appreciate the position of retail shareholders within our book, and fundamentally, I would not look to exclude them. They represent a decent proportion of our shareholders at the moment. And it would be short-sighted of us to ignore them in the long term.
Thank you very much.
Thank you, Richard. Thank you, everybody.
Thanks, Nick.
Thank you for that presentation from Tritax EuroBox, and thank you, Richard, for the questions.